Non-correlated investing. What does that even mean? Let me put it this way. It's a method of investing, but it's a thought process as well. It's about the desire to be independent. It's about searching for and finding the performance drivers and the return streams that are not entirely correlated to the performance of the stock market, particularly during crisis. But it's a thought process that examines all sides of an issue without political or economic bias. Not only does a non-correlated thinker look at all sides of an issue, but they seek out opposing information. They play devil's advocate to a thesis. They look for credible information that disagrees with their opinion. There are a number of renowned fund managers who take this approach, and they look at macro issues as well as idiosyncratic issues to find investment opportunity. They use a variety of execution methods, and in fact, some of the long-only stock investors use non-correlated thinking, this analysis that looks at all issues without a bias. That's non-correlated thinking. I found a recent Blackstone Investment News survey of investors fascinating. Of those who wanted alternatives, they asked them, why do you want an alternative investment? The number 1 and 2 reason were diversification and tamping down volatility. And by far, those were the number 1 and 2 reasons. Here's what's so interesting. That's singing from the non-correlated choir. The problem is there's no standard way to understand, evaluate, benchmark, and then manage these investments going forward. That's what this website, the related podcasts, the newsletter, the education series, the consulting service all encompasses. Given this is the high-level approach, there is a specific correlation strategy that we're going to use to build portfolios. And the important point is they operate in a variety of market environments. This is one of the keys to my thinking. The approach is similar to factor investing on the equity side, except I look for algorithmic beta market environments. If you look at a formula that drives an investing or trading strategy, that formula at its core is exploiting a beta market environment, in my opinion. Any market event that repeats, from my perspective, can be categorized as a beta market environment. So when I look at formulas and I analyze these different non-correlated investments, the component that I'm first looking for is the beta correlations and the performance drivers that are making decisions on when to enter markets, how to position size, and when to exit markets. You can understand the value that is being offered you by looking at the Northwestern University executive education program that I taught and the work I did in 4 books, where I either wrote the book, edited, or contributed to it. I'll try and put it all together in a few sentences. My career has been dedicated to helping people understand complex investments and then build non-correlated portfolios. Both the practitioner side of my career and, more recently, the journalistic side of my career. What I do is I use a set of systematic principles, a mathematical logic that's based on statistical analysis. And then I combine this with a fundamental understanding of how the strategies operate, and I try and tie a strategy to its economic drivers, not only its mathematical drivers, but the economic drivers that often lead to price persistence, volatility, or mean reversion. You can see this thinking throughout the books I wrote. The first book I wrote was published in 2000, and it logically modeled the rise of intelligent computer systems, and it did so at a time where people weren't really dialed into that thought process. Most people were dialing up to the internet in modems. At the time, the thought that algorithms would be trading with each other, making up 80% of the total market, was a far-fetched idea. And there were a lot of other things. Personalization wasn't really understood to the degree it is now. And the ability of a computer to think. And what I did in this first book is I looked at what I had done with integrating some intelligent computer systems in some large corporations, and the big takeaway was the framework. It's important to have a solid framework to understand both the potential and the limits of computer-based thought processes. A key component of a lot of algorithmic-based systems can be found in the use of derivatives. There is an exchange structure that's a little different from the equity world. There aren't dark pools. Transactions in the listed derivatives industry are transparent. There's a central clearing mechanism that keeps the person in the middle of the trade away from directional risk. There are a number of key mechanisms in risk management and how derivatives are used that are sort of pillars of non-correlated thinking. When you look at the history of hedge funds, they were founded in 1950, the original purpose wasn't to beat a stock market average. I know that that's a tough task to do on a regular basis. But what you can do on a little more consistent basis is be non-correlated. And there's a logic behind that. And that's what the hedge fund industry was originally founded to do. It was founded to hedge. The second book I was involved in co-editing was an update of the Chicago Board of Trade's Handbook of Futures and Options. It was published by McGraw-Hill in 2006. What this book did is it took apart some of the key principles in derivatives management and it looked at the history of the industry. I'm going to be honest, my co-editor probably did more work on this than I did. But the key takeaway here are the core principles of how the derivatives industry works and how it manages risk. And it's important to frame your understanding based on a core set of principles. And in part, that's what this book did. The third book I wrote was published by Wiley in 2010. And the fourth book, where I contributed a chapter, came out a little later. But they both focused on evaluating managed futures CTA investments, understanding volatility management, and recognizing beta market environments. This has some specific applications when you start to build a non-correlated investing strategy. Now, I've worked as both a practitioner building strategies and as a journalist covering hedge funds. I actually like the work of the journalist better. I used to think I was on the inside of the derivatives industry to a certain extent. But when I became a journalist, I realized there's a whole world behind the scenes that is just absolutely fascinating. And I usually like to talk from a behind-the-scenes perspective. The Corzine investigation was blocked. How did Klanovic call the flash crash? Chicago FBI puts an HFT trader behind bars. You don't mess with market security. What does all that mean? Brexit mean reversion. Get to the performance drivers and look at the consensus and understand what they're not talking about. And I'm going to provide an interesting story here. I was working with a hedge fund on some research, and I had presented my findings. I'm in what's the investment thesis pitch, and I'm going through the statistical analysis of talking how this particular trading strategy would model in different market environments. I'm getting ready to deliver the big punch, and he stops me. He looks up at a TV. There's a cable news show on. He's like, I need to hear this report. I looked at him, I said, what are you talking about? Now, this guy is a guy who pays probably $10,000 a month for information. He says to me, Mark, I'm not looking for what's in the news. I'm looking for what's not in the news. And that's really an interesting approach to take. When you look at the consensus thesis and you understand what's not being discussed, that's where the opportunities are found. They're not found in what the mainstream knows. It's what the mainstream doesn't know where opportunity is. When you like looking at the financial services industry from behind the scenes, and you like to take a logical, math-based approach to everything around you, and you look at information from all sides, and you analyze everything without a bias, that's a non-correlated thinker. I like to take a non-biased journalistic approach to the world. And I like to look at the performance factors and risk management techniques in every strategy. And then I like to map that strategy to its beta market performance driver. When you're thinking non-correlated, it's kind of like surfing a wave. You get in that tube and things can become clear. On this website, from the podcast section, you're going to be able to access interviews with top non-correlated thinkers. And they're not always going to have a non-correlated strategy. There are going to be some long-only people we have on the podcast because they think like non-correlated thinkers. They play devil's advocate. They're looking at all sides of issues, and they're developing probability paths. They aren't absolutes. From the education tab, we're going to be adding new tutorials and guest speakers all the time. And then from the non-correlated news tab, we're going to allow you to access the latest information and developments in the space. I hope you explore this website. Sign up for a newsletter. Take a complimentary educational video tour. Get everything you can out of it and start thinking like a non-correlated investor.